Well, hello everyone, and welcome to ACT's September Industry Review. You'll notice there's a new addition to the logo on the front page. I wanted to take this opportunity to thank Penske for becoming the sponsor of this webinar series. They'll be sponsoring this year as well as, I believe, into the 2021 timeframe. So thanks again to Penske for that. If we could, I'd like to take just a moment of silence to remember the folks who have given their lives to this pandemic. It's been 928,890 folks who have given up their lives for this. Just a moment of silence for them, please. Okay, thanks for that. I appreciate it. So for those of you who might not have been on the call before, I'm Steve Tam. I'll be hosting as well as presenting in today's webinar. Our agenda is largely unchanged. Jim Neal is going to present the economy to us this time around, and Tim will pick up the baton from Jim and talk about what's happening in the freight transportation markets. Kenny will cover Class 8 as usual, and then I will follow with the medium duty and the used truck piece of the market. And then perhaps appropriately for trailing equipment, Frank will talk about what's happening in that segment of the market. And then we'll open it up to Q&A at the end of the session. So well, I guess I should do a couple of housekeeping items first of all. We will have a recording available. We'll send out an email link to each of you who are on the call now in case you want to listen or refer to something at a later date. You can get a copy of the slides right now if you go up to the File menu and click on Save As. You can save that off as a PDF. That will also be included as part of the link we send a little bit later on. And then for the Q&A itself, we'll use the chat box, and you can chat your questions to ACT Research, and I will facilitate those. So we'll do that at the end, but you can chat your questions throughout. Two other reminders. I think I've got everybody on mute. We try to do that, but if you would happen to unmute yourself, please remute yourself. And also, obviously, if you did intend to broadcast your image, you might want to close your camera, turn it off, put a piece of electrical tape over the lens, whatever sneaky trick you use. So that's it for housekeeping. I'm using too much time here, but Ian wanted me to pass along a couple of notes to you as well. In case you haven't gotten the notification yet, it is renewal time, so those emails have gone out. I would say that in consideration of the current economy, there are a couple opportunities in the renewals for you to save money. I won't go into the details now, but if you have any questions, you can contact Debbie Steinbarger, and she'll be more than happy to work with you on that. Also, not too long ago, we announced our restart of our efforts to update or refresh the commercial vehicle study that we did on electrification back in 2018. COVID squashed our earlier plans, but we will not be kept down, so we are resurrecting that update. We've sent some information around. If you haven't seen it, here's kind of the crux of what we're doing. One of the things that you'll note on there is that we're going to be adding fuel cell to this particular study, but should be a pretty good refresh, and with all the activity that's taking place right now, very timely. So one difference for the study this time around, for those who are not interested in the entire universe of commercial vehicles or of alternative fuels, perhaps, it is possible to purchase select segments of the study. So any questions about that, Ian is the person that you should speak to. And then my last announcement before I hand this over to Jim Neal is we've recently updated what used to be our alternative fuels calculator. The calculator now is more of a framework to compare side by side costs of different alternative fuels, including societal costs. So we think that's a pretty decent update to this, and I think also quite relative given everything that's going on with emissions and other things in that vein. So Jim, I'm going to shut up. You take the baton. Tell us all about what's happening in the economy.
Thanks, Steve, and hello, everybody. Over the next few minutes, we're going to talk about a few things here. 5 major themes that we see at work in the North American economy as we close out 2020 and launch into 2021. First, reflecting on history, the COVID-19 2020 recession may set a record for severity. In fact, we can remove the word may from there. It did. The second quarter of 2020 was the worst in U.S. history, going all the way back to World War II, going all the way back to the Depression. But in more than a dead cat bounce, it's shaping up to be a very strong Q3 rebound. I mean, it's no doubt about it, a second half recovery, something that we had been forecasting for quite some time, going all the way back to April and May. But this rebound is even stronger than we expected, in part because of the hole that we dug in the second quarter. Going on from there, the Federal Reserve Chairman Powell has pledged to keep interest rates low indefinitely, maybe not forever, but at least for a long time. We'll be talking about that. We're looking at a rebound that is not confined just to North America, but it is really global. Almost all countries around the world are participating in it, so that's a plus going forward. But we're very, very aware of the fact that until a COVID cure comes along, a vaccine or herd immunity or whatever, the risk remains high going forward. Finally, in a very important key insight for freight, and this will be a point that I make, and then when I pass the baton to my colleague Tim DeNoyer, he'll reinforce it. It's really a very unique recovery because goods are prospering, relatively speaking, while the services sector has been pummeled. So those are our 5 themes. Let's go on and explore what's going on here. This slide shows a review of our forecast on the far left-hand column, going back to the start of this year, quarter by quarter by quarter. So the first 2 rows in this are history. Then if we look at the middle row on this chart, we see our own forecast for the Q3 rebound, and we're certainly not unique. If you go from left to right, you'll see that it's pretty much unanimous. These leading forecasters are all seeing a very, very strong rebound in the third quarter. And again, it's no surprise. I mean, it's September 15th. We're most of the way through our third quarter. We've got a lot of the August data in, so we know it's pretty much a thumbs-up affair, no doubt about it. As we work our way forward, you start to see some disparities with regard to the outlook. We're sort of middle of the pack, and it really is a story of reading the risk going forward, reading the story of potential stimulus going forward, but at least our best guess and those of our forecasting colleagues is that as we close out this year and go into 2021, we're probably not going to have the W. We're probably going to see this momentum continue into 2021. The Federal Reserve promised to keep rates low. That came out in Chairman Powell's July 29th announcement. This, in essence, reverses an almost generational anti-inflation stance that dates all the way back to Chairman Volcker in 1979, where the Federal Reserve committed to keep inflation under control by acting preemptively if necessary, depending upon reading and signals of inflation and the health of the overall economy. Now the Federal Reserve has basically said we have to see evident signs of inflation before we move away from our highly stimulative stance. So chalk one up for the Fed taking 4 square actions to keep the economy and to keep the recovery going. A little bit of an eye chart here, but the real point of this survey, which is a review of the purchasing manager's numbers, is to get an idea of the history that it tells around the world as we start with the left-hand side rows, going all the way back to 2018, when growth around the world was on a pretty solid footing. We advance into 2019, which we'll all recall was pretty much a so-so year. So that's why we paint a lot of these boxes yellow. Then we move into 2020. The red columns stand out. The purchasing managers' numbers around the world were reaching as low as ever has been taken in the 20 years history of this survey. But the most encouraging part, obviously, are the readings that we get for June, July, and August. If you figure the purchasing managers are in essence rendering an approval rating in this political season, a thumbs up, thumbs down, we're starting to see most of the world enter into trend growth type territory or even green type territory, that is to say, above trend expansion. I will take note of two exceptions to this. If we look at our North American partner, Mexico, Mexico is a laggard in this global recovery. Much the same holds true for Japan. Japan economic results have been disappointing. So keep those in mind, but going around most of the rest of the world, we're talking about some pretty strong numbers. Proceeding on from there, it's no secret what makes the expansion vulnerable is COVID. And particularly as we head through the fall and into the winter, we've got school reopening, and the story still needs to be told on that with regard to the potential it creates for a third wave in September with new reporting cases. And then, of course, in Canada and the northern part of the U.S., the winter is going to turn severe. So a lot of our ability to go to outdoor venues and take advantage of restaurants and bars with outdoor decks, that's not going to work in the Northeast once we get into November and December. So there's some legitimate head scratching going on there. It's always difficult to show an eye chart, but if you work with me on this really brings home the point, I believe, with regard to the transformation that's been going on for the last few months in terms of consumer spending on goods and the retreat away from services. What this chart does is it starts in January, standardizes consumer expenditures at 100. And if we look from left to right as we progress from month to month to month, we see a big drop in overall consumer spending. At its worst in April, consumers shut their purses, shut down their pocketbooks to the tune of almost 20%. That was the April low. And since then, we've seen consumer spending struggle back, climb back, and now is only 4.5% below where we stood pre-COVID in January. But take a look critically at that mix. Durable goods, which ordinarily get hammered in a recession, are doing quite well. Take a look at that motor vehicles line, and keep in mind that includes not only new cars, but used cars, and includes auto parts. Those expenditures in the month of July were actually higher than they were in January. Likewise for furniture, appliances, and other household goods, roughly 8% higher than they were in January. And then if you take a look at recreational goods and services, recreational goods and vehicles, where a lot of your home entertainment, home personal computers, home technology will be found, that's upwards of 20% higher than it was in January. So as people have retreated inside their homes, they're willing to spend on furniture, on appliances, and even on cars. Now, what's been pummeled? Take a look at the bottom. Transportation services like airlines, down 25% compared to January spending levels. Recreational services, down 36%. Nobody's going to concerts anymore. Nobody's going to restaurants and bars anymore. Look at the food services line. Swing back up to energy goods, gasoline. Obviously, both a price and a volume story there. Food and beverages. Who would have thought grocery stores would be a growth business? But that's the nature of the times that we have right now. So the big picture and the big story here is that if people are spending their money on stuff instead of services, that actually goes into the sweet spot for truck transportation. And that's the real takeaway that we have here. So with that, 5 things to look for in the fourth quarter. Keep watching the purchasing managers. Keep watching the employment report. Keep an eye on prices, equities, crude oil and copper. Confidence measures post-election, going back to November 2016, consumer confidence measures and the NFIB small business confidence measure took a jump. No matter what the outcome is, it'll be very interesting to see what the household reaction or what the small business reaction is to November election results. And of course, with COVID-19, keep track of the new case count. So that's the mission. That's what we'll be watching. And with that, I will turn it over to my colleague, Tim Denoyer.
Can you hear me?
Yes.
Great. Awesome. And hello, everyone. So for an overview of the freight market here on slide 15, we should perhaps start with the second bullet here, because the supply side really is everything right now. We wrote in the freight forecast report this month how it really is a testament to the importance of the supply side in freight markets, that the dry van spot rates are now at record highs, even as freight volumes are roughly flattish with where they were a year ago, although the dispersion in freight data remains unusually elevated at the moment. But the economic equation here is fairly simple. Both the supply side and the demand side are pressing rates higher, and we're now forecasting double-digit growth in spot rates for both this year and next year. And as we've been saying, this is not a problem of too few trucks, rather too few drivers and too many drivers on the couch. We're collecting upsized and extended unemployment benefits from the federal stimulus package. And so while the talk in Washington right now is all about another stimulus package, I'm not expecting one before the election. And if they do get something done, I think it would actually extend and add to this truck driver capacity tightness that we're feeling, and it would probably add to freight demand as well, which would push our forecast even higher. But our base case is that drivers come back gradually in the near term, and then more so in early 21 as the extended unemployment benefits expire, which is likely to pressure rates downward at the margin early next year. But equipment capacity is gradually tightening, and we think that should put more upward pressure on rates next year. Okay, so moving to the truckload spot market here. In August, dry van spot rates net of fuel surcharge on the DAT load board were up 33% year over year. And here in early September, which is not actually on the chart, we're up about 39%. Our spot leading indicator, which is derived from our survey data, which I'll get into a little bit later, is suggesting that rates will be up about 30% year over year over the next few months. And while it did drop to 20% in the latest reading, it is a purposefully volatile series, and some of that volatility has to do with prior year comps, which do ease next month. And so I expect this to move back up to the 30 to 40% range in the next reading. So the short-term outlook is very positive, and I'll add one more point here on the slide that I think the typical 6-month lag between spot rates, which are about a quarter of the truckload market, and contract rates, which are most of the rest, could be shortened this cycle because this acute tightness in driver capacity is causing route guides to break down, which forces shippers to conduct mini bids for certain lanes where they need capacity. I think those are coming in at significantly higher rates, so the contract rate cycle is already beginning. Okay, so slide 17 makes the point here that the pandemic has really accelerated this truck cycle because of the driver supply shock that occurred in March and April when almost 100,000 trucking employees lost their jobs per the BLS data, and there were probably tens of thousands of other owner-operators and private fleet drivers who were not in this data set who were sidelined as well. And even after adding the 19,000 jobs back in the past 4 months from May through August, we're still down 76,000 jobs year to date. And as I'll cover next, we're back to roughly flattish freight volumes, and so that's a big shortfall. And there's also pressure here from the Drug and Alcohol Clearinghouse and closures of driver schools earlier this year, but the schools have been reopened for a few months, so that constraint should ease a bit from here. But even if job gains accelerate from the 10,000 added in August, it is clear from this chart that the driver shortage will take several more months to rebalance. All right. So as truckload capacity is extraordinarily tight, freight volumes are staging a brisk recovery, and we can finally say with good confidence that the freight recession that has lasted the past 7 quarters, the rail data, is finally ending. And while we don't think there is a wonderful proxy for overall truckload volumes, we can't look at intermodal for a rough guide, and I think it's been fairly representative over the past few months. Until the surge in the past couple of weeks, which has turned the quarter-to-date trend in intermodal actually positive on a year-to-year basis in Q3 now for the first time in over 6 quarters. So I wouldn't say that the 20% surge in the week that ended September 5th here is it's representative of much. So that's comping against Labor Day week of last year. So you really need to take average of the past 2 weeks together to understand what's happening. And intermodal volumes were up about 8% over the past 2 weeks, which is starting to significantly outperform truckload volumes in my view. I think as shippers are rushing to the lowest cost mode to restock shelves ahead of the holidays. And you may have seen the recent news of the Union Pacific's $5,000 per load peak season spot intermodal surcharge, which roughly triples the price of that shipment, and will restrict rail capacity to those with contracts pretty much. So I don't think intermodal volumes will accelerate much more, but I think that's a real sign of tightness in that market. Although Q4 comparisons are easier because the railroads are very reticent to add the costs back. But imports are surging, and particularly on the West Coast. And while we don't have a ton of August data, container imports are up 23% on a seasonally adjusted basis from the bottom of March through July. And August is showing signs of continued improvement, really elevated demand that we haven't seen since before last year's trade war put a dent in activity. And as I foreshadowed, spot rates for intermodal have really gone parabolic recently, and I think the chart on the left here incorporates that Union Pacific peak season surcharge, but it also reflects that that's not on every lane, so it's not the full $5,000 there. But overall, intermodal rates are up 50 to 60% in the past couple of weeks, and so rail capacity is effectively sold out, at least the West Coast import transcontinental moves into the holiday season. So that's clearly going to translate into strong trucking rates to fill that void in the coming months, but it also has longer-term implications for the share of the freight market that will move by truckload versus intermodal. The chart on the right compares truckload to intermodal rates on a per-mile basis, and we can see that in the past few weeks, the historic discount of intermodal has disappeared as they're effectively at parity at the moment. And when that happened in 2018, intermodal subsequently lost share to truck, as did for-hire truckload, as the private fleet stepped in and grew in a big way in 2019. So this is perhaps a medium-term risk for intermodal volumes. Okay, this slide shows the LTL tonnage essentially returned to flat in August, and we think this has further upside both from the LTL perspective and the cash shipment index will continue to follow in the recovery pattern here. And this is lagging what's happening in intermodal because LTL tends to be a bit more costly on a per pound basis, so it's not the first choice. But with the tightness in the truckload sector, along with the eventual recovery in the U.S. industrial sector, which is coming from a low base after a rough couple of years, should also help LTL tonnage. And of course, there's still the e-commerce angle helping it a bit here as well. And lastly, on the volume side of things, I'm sure you've had all had trouble finding things in stock online and in stores recently, and if you're willing to dare to go into a store. But this shows this. Well, this is the terribly lagged census data. Total U.S. inventories were down 6% year over year at the end of June, and with goods consumption still strong and supported by this services to goods transition, which Kenny will also talk about in 50 minutes, due to the pandemic. The inventory situation doesn't seem to have improved much in the past couple of months, which is why we're seeing this sort of crush of imports. And we've done some sort of rough math on based on the inventory to sales ratio. If we were to return inventories back to that 5% year-over-year growth trend that it was on before the pandemic, that would be over $200 billion worth of products, and it would add about 3% to freight volumes if it happened over 6 months. So big tailwind. And while there's always the risk that inventory tailwinds are temporary, as this inevitably will be in some form, we also think the structural shift towards e-commerce and low interest rates will lead to a structural increase in inventory levels. So some of this is sustainable growth. Okay, so coming back to rates. This slide shows two of the key outputs for our for-hire carrier survey, with the supply-demand balance swinging from historically loose in April and May to historically tight since then. And that's just materially improved the freight rate outlook. And we find that the freight rate chart on the right side of this slide to be a very good indicator of where rates are heading, not just where they are today. And moving to the next slide, while the equipment tightening in our active truckload and LTL population model has been reduced from 3 to 4% a few months ago to 1 to 2% now, as the Class 8 tractor sales outlook has improved, we still expect a reduction in capacity over the next few quarters, and we don't expect tractor capacity to begin to grow again until the back half of 2021. I don't think that's really what's driving up rates, at least yet, but the market is now more balanced from an equipment perspective, as both the population and freight volumes are roughly flattish year over year. And so we expect this to add to upward pressure on freight rates in 2021, more in the middle of the year. And finally, here's our spot rate forecast. Near term, spot rates are trending up 35 to 40% year over year. And while we are modeling a pullback in early 2021 with that driver capacity tightness easing as drivers come back into the market, you see equipment capacity tightness driving that uptrend thereafter. And I'd also note, even in that uptrend, we'll be facing such extraordinary comparisons a year from now that it's likely we'll see some year-over-year declines this time next year. But overall, while this is somewhat front-end loaded, we do expect this spot rate composite, which it does include dry van, reefer, and flatbed, to be up double digits both this year and next. It's a little bit more front-end loaded with dry van. It's up 15% this year and about up 10% next. But this should be really positive for carrier profitability and equipment demand. And with that, I will pass it over to my good friend Kenny V.
Well, thank you very much, Tim. Good morning, everyone. And I would like to reiterate what Steve had to say in thanking Penske for becoming a sponsor of the webinar series. We certainly appreciate our relationship with them and the good work and insights that they help us with as we strive to be stewards of data and forecasts. So, turning to the Class 8 market, really, I think Jim and Tim really teed us up, because Class 8 demand, doesn't work without a growing economy and more importantly, truckers making money. And as has been said, the economy is growing in all the right places, it's driving stronger than expected carrier profits. I think exogenous factors remain supportive in the marketplace. I think there's a new must-have spec that's been out there since about 2017 that continues to support late model valuations, especially if you look at that like 3-year and under used truck valuation. I think there's longer term driver constraints. We'll touch on those. And then, if it gets through the courts, and this is more of a long-term heads up as opposed to a short-term issue. CARB did greenlight their low NOx and warranty regulations that go into effect in 2024. So we do anticipate that if this gets through the courts, it will drive a California and California following state pre-buy that could be fairly significant in 2023. And we think, given the way the economy is tracking right now and coming out of the recession, there's always two factors in a pre-buy. It's truckers' willingness to pre-buy, and we think this is a very expensive regulation on a go-it-alone California basis. So a 6 handle is a 5-digit number with a 6 handle is not out of the question for 2024. Though it's not it's not just a willingness to pre-buy. Truckers also need an ability to pre-buy, and if Tim is correct in rate prognostication, truckers should be coming into 2023 with strong contract rates and having the ability to do something about avoiding California's regs starting at least initially in 2024. Where we are right now is we are seeing orders rising to support current build plans. There was some backlog burning that was going on. That's largely subsided. We've had a flat backlog for a few months, and healthy backlog to build ratios. Production is running ahead of inventory. We will touch on that. The inventory cuts that were a big part of our forecast back in April and May have largely been thrown out the window. So I think just starting out in the upper left-hand corner, I think that's basically a caricature of Jim's slide 13. Tim showed the truck transportation employment, and if you notice, and Tim talking about getting I guess mine is a percentage chart as opposed to an absolute numbers chart. But if you go back and look at Tim's absolute numbers chart, very rarely do we see 10,000 jobs being created a month in the industry. It's 5,000 or 6,000 a month. So we've got this big decrement in truck drivers. They're just not going to come flooding back into the market right away. So I think it does set the table for the last chart. Again, what Tim talked about. I do want to point out we do pay attention to the rate spread between contract and spot rates, because that rate spread helps drive contract pricing at roughly every 2 percentage points of spot rate equals 1 percentage point of contract rate improvement, at least historically, at about a 5-month lag. So as Tim pointed out, we're starting to get some mini bids as shippers are scrambling in different parts of the country. But certainly this is interesting to watch, and this inversion or backwardation in the rate spread was extremely bullish for carrier profitability in 2018 into 2019. If the economy doesn't fall apart from here, I think this has got to be an extremely bullish sign. For carrier profitability and by extension Class 8 demand. And here's a picture of Tim's got his chart. This is my look at implied fleet utilization, and it's really a two-sided story. As Tim mentioned, there's plenty of trucks in the market. Based on the factors we look at, right now we think there's about 5% more trucks in the market, or 5.5 more trucks in the market that are actually needed to haul the freight that's out there right now. So think in terms of call it 80 to 85,000 more trucks that are needed. But because we are so short on drivers, it's not just the 5+% shortfall in the for-hire market, which is the only thing that the BLS is tracking, but it's private fleet drivers that have been laid off and let go. It's owner-operators who have parked their equipment. So right now we have an extremely strong case to be made for the driver shortfall to continue, basically through 2021. Hit the wrong button. Per the forecast. That's better. One of the things that's going to help keep the driver situation tight is just U.S. demographics, and for anybody that's been with us for any length of time, you've seen me show this chart before. So the blue line is the number of 21-year-olds entering the U.S. economy on an annual basis, right around 4.4 million new 21-year-olds every year. The red line here is the number of 65-year-olds that are at least potentially exiting the U.S. economy on an annual basis. And as you look out over the next decade, the labor force is projected to grow at about 0.5% per year. An aging workforce implies a lower participation rate on top of that. The conclusion that I think we draw is increasingly sharp driver shortages around economic inflections. So if we get an infrastructure project after next year, after the election, for the next couple of years, it's just going to help inflect the economy and keep things significantly tight on the driver supply. Touching on the must-have spec, and I've got a U15 population. These are the exact same data. One using a 15-year population and one using an 11-year population, and this is tractors specifically. One thing we have learned from Steve's work in the used truck market is by the time trucks get to 11 years old, they're doing very little work. But the takeaway here is, whether we're looking at the U15 market, only about 34% of the trucks are in the, kind of that must-have spec period by the end of 2020. If we use the U11, it's about 40%. But still, I think that provides good pull-through for the next few years. And certainly we see that in used equipment valuations. And the must-have spec, starting around 2017, is significantly better fuel economy, and sharply increased automated manual transmission and autonomous driver assistance system penetration in those vehicles. Just seeing what's happened to orders the last few months. In June we saw things turn around, and in July and August we had the two best months since the fourth quarter of 2018. Granted, some pretty easy comps to run up against, but July and August aren't typically the months where you're going to see that rebound. Just touching on our current forecast of just over 250,000 units for 2021 implies we should be seeing orders in the fourth quarter in that 25 to 26,000 unit per month average. And then just a chart that I don't think anybody's seen except a few of us around ACT Research. I threw together a 6-month order proxy out of the backlog analysis, and basically I think the way to interpret this is when the proxy is under 60%, that corresponds with very strong markets. When it's over 60%, it tends to correspond with very weak markets. Currently we're right at that 60% mark, but because the backlog is so forward right now in time to build, at the end of July it was 82%. It would suggest that we should start seeing more forward orders, and certainly with the fall order season approaching, it will be interesting to see how this tracks in time being. And you can see that at the end of July, we did have very strong front-end fill rates. In the third quarter, we were at 107% of what's typically a 90% fill rate at the end of July for Q3. Fourth quarter is tracking right in line at 66%. One thing that we are seeing shortfall right now is at the end of July, the Q1 plan was only 18% filled to our forecast, I should add, as opposed to the OEM's build plans, versus what's typically a 29% fill rate here. So the good news is strong fill, very very solid path into the end of 2020. But certainly that very forward filled backlog and kind of the absence of orders in Q1 does suggest that we need to see orders ramping up. The inventories, as I said in my opening comments, we were thinking, kind of like the 2009, 2010 experience, we would see inventories ending 2020 in the 30 to 35,000 unit range. Currently, we note here that the July to December inventory change over the last 10 years has been about 4,700 units, to the goods. So, currently at about 62,000 units, we'd see the inventory end this year if we hit the average at about 57,000 units. Again, there's roughly 20 to 25,000 units of the change in the forecast that we've had for 2020. Just in that inventory change, and you can see on the right hand side we have our inventory target, which is based on a 2.25 month inventory to sales ratio, which is the black line there, which is saying we should be around 40,000 units of inventory right now, based on the retail sales rate as opposed to that 62,000. So the good news is retail sales are going to recover from here, but certainly we have to get the retail sales to recover. So with that, Steve, am I out of slides? I am. So let me turn it over to you. And you're on mute.
Okay, so
all right.
Taking a look at what's happening in the medium duty space. We just got our preliminary or same dealer sales numbers for the August timeframe a day or two ago. I guess we got them out yesterday. And happily, I can report that at least on the retail side in those preliminary numbers, we saw a pretty good sequential increase to just over $43,000. So good to see that. In the retail space, we're still lagging on a year-to-date basis. We had, up until this point, we've seen that gap being nibbled away at. In the all-in numbers, it is, in fact, making a little bit better progress than on the retail side. So the auction and wholesale markets, at least in the interim, are coming back a little bit more quickly or a little more strongly than the retail side. But I think the retail side will ultimately prevail. One of the things, of course, that's helping prices improve is, we continue to see better and better quality trucks, if you will, vis-a-vis mileage and age, making their way into the secondary market. So we like to see that and believe that trend will most likely continue. The other thing that we're seeing in the context of what you've heard all three of the previous speakers talk about, folks coming into this marketplace, we're seeing that drive inventories down. Not significantly. I think I went back and I looked, and over the last month, we've probably seen about an 8% or so decrease in inventory. And when I say inventory, I should probably put air quotes on that. We don't have empirical data that actually the dealers are reporting yet, but we look at metrics that inform on where inventory is likely headed, things like classified listings and that sort of thing. And so when I talk about numbers, that's really what I'm referring to. Lastly, just summarizing or overviewing the used market is the export market. We have seen a couple of good months of sequential improvement in volumes, but we continue to lag again on a year-to-date basis. So, and that lag actually increased in the July timeframe, the most recent data that's available. I think from June to July, we went from a deficit of about 18% to one of 19%. So taking a look at some of the specific data points, on the left there, you're looking at pricing, and you can see, again, focusing on the blue bars at the bottom, we're not down for the count. We're coming back. So pricing is becoming less negative, in part because of easier comparisons in the latter half of 2019. But you can also see the sequential improvements that I mentioned just a minute ago. That's an all-in number, so that's auction, wholesale, retail, irrespective of age. So it's kind of a composite number. And then the graph on the right breaks out, kind of one of our proxies for late model, low mileage equipment. And you can see a similar trend taking place there. It actually started a little bit sooner. And that's that kind of transference as the new truck market clammed up as production was shut down and availability maybe wasn't as good as it could have been. And there were questions about profitability, so that willingness to buy that Kenny mentioned. We believe that a number of folks turned to the secondary markets to meet their equipment needs, and I think that pricing reflects that. Taking a look at the mileage and age that I mentioned, you can see both of those are trending down. At least this year is the direction that we're seeing. And there's not going to be a tremendous amount of movement here, but as fleets are starting to I guess maybe divest themselves of some of this underutilized equipment, I think this is the phenomenon manifesting itself. And of course, better the market for it on the secondary side. And then my last picture on the used truck piece, here are the exports. This is data through July, and that represents about 6,800 units. So we've kept our expectations the same for 2020 over the last couple of months. Somewhere in the 12,000, 12,500 unit range is likely what we can expect to see. A couple of thoughts there. First of all, Jim showed you the picture of the globe, and it pretty much paralleled what we experienced here in North America. And so it doesn't surprise that demand falls off. I think one of the nuances is that with the slowdown in ocean-going traffic, vessel traffic, it's just physically harder to get a truck offshore. Granted, a lot of them do head to Mexico, but of course their economy is not doing so well. But I think as we start to see more ships making the crossings, that will at least help to facilitate the opportunity for exports. We'll see what happens. Taking a look at the medium-duty market, really from a backlog to build perspective, things are doing pretty good. That's why I've got that grayed out. We're actually at the low end of the range, suggesting some upward pressure on build, and you've seen that in the forecast. They've crept up over the last several months. We're still beset, just like the Class 8 market, with too much inventory. And in fact, when you look at the forecast, you'll see there's a bigger delta in the production forecast than the retail sales. So we still believe that we're going to see some further reduction on the inventory side. The middle bullet there, when the sky fell, if you will, proverbially, everybody just slashed and burned as far as expectations were concerned. And happily, the market, it was not as bad as maybe some of our, maybe not worst nightmares, but really bad nightmares. And so we're adding back to that. Jim alluded to a little bit about it in the goods versus services, and I'll reinforce that point here in just a minute. But, typically, when you think about the medium-duty market, it's much more diversified than the Class 8 market, with a much higher participation in the services side economy. And so I think that's really the downside in the space right now. And fortunately for the medium-duty market, it is being subsidized by increased goods movement. The last point refers primarily to folks like the lease rental companies, some of the higher volume buyers, maybe, if you will, private fleets. We saw kind of the same reaction. Capital spending budgets were slashed because of the COVID and also because of the uncertainty of the path of recovery. And we're starting to see some of those dollars added back to the budget, which is helping us, particularly on the order front, which is my next slide. You can see over the past 12 months, just below 200,000 units have been placed. I'm tracking the column on the far right. And the closer we got, or the further in we get, the order demand was continuing to evaporate until we got to the July timeframe, and really even June. So for the last 3 months, June, July, and August, we've actually seen some pretty decent order numbers put up for the medium-duty market. And I think, again, that's the customers and the space getting kind of comfortable with where we're at, understanding the dynamics in the economy and how they're impacting the various drivers that cause folks to want to buy medium-duty equipment, and then reacting accordingly. This chart is nothing short of phenomenal. Don't know if you've seen this yet, but the spike in e-commerce as a percentage of retail sales, I think, is another thing that's fueling the optimism or waning pessimism, depending on which flavor you are. in this space. The retail sales in the economy are roughly $4 trillion, I believe, and so you're looking at about a 4 percentage point move, so almost $150 billion or $160 billion from one quarter to the next as far as an increase in e-commerce and retail sales. I think, unless I miss my guess, what you're going to see is a continuation of the slope that we had prior to second quarter of this year, but at a markedly higher absolute level. So I think we maintain that delta, that step function, and then continue to grow on the path that we were on. Of course, this bodes very well for medium duty because so much of the activity that's being transacted here is going to get delivered to the home, last mile, whatever you want to call it. And I think we're still early enough days in this whole thing that we're in an undisciplined fashion throwing capacity at the problem, if you will, to meet it or to take care of that demand. And I think that trend continues for quite some time. Eventually, there will be a rationalization, but not now. So, just another testament, I guess, to the relationship between light vehicle sales and medium-duty truck sales. You can see a very parallel path there that's really kind of tightening up that relationship. I won't belabor the point. This is a new phenomenon that we're all hearing about, folks fleeing, if you will, the cities, moving to the suburbs, or perhaps, as the picture suggests here, maybe even out into utopia, into the urban parts of the country. But whatever's happening, in July, existing home sales were the highest they've been since February of 2007, which of course was before the housing market imploded. They also experienced the largest month-over-month gain in sales in the history of that metric. And, it has driven inventories essentially to lowest levels on record, which of course is causing pricing to maintain very well. On the new truck side of the business, same kind of deal, best that we've seen since the end of 2006. So we're making some inroads here. We're not back to where we were pre-COVID. And I think a lot of the growth that we're going to experience this year may already be in place. I think the forecast for next year, something like for this year, kind of 3.5 to 4, maybe 4.2% increase in housing. But we've already seen a lot of that. We'll see better next year. I think will be the case as people get more comfortable with the COVID environment and with transacting properties in the new world that we seem to be living in right now. The other comment that I would make, just again reinforcing on consumer spending, you see I've got a picture of for those of you who don't recognize it, a picture of the Maytag repairman, arguably the most boring job on earth because allegedly the product quality is so good. You see, he's the chairman of the board, B-O-R-E-D, as opposed to B-O-A-R-D. And this is what's happening in services right now, right? Consumers have turned tail and run. They're voting hands down on goods, and the goods picture is not all that great. So PCE, or personal consumption, in the second quarter was down 34%, but the dichotomy is unbelievable. Goods were only down 11%, while services were down almost half. So that poor guy that was so bored before, I don't know what he's doing now. If you look at our forecast for consumer spending, we don't get back to pre-COVID levels until sometime between third and fourth quarter of next year. So still some room to recover, to run in the medium duty space is essentially, I guess, the bottom line in this presentation. So quick picture of the forecast while I cue Frank up and get him ready to tell you about the trailer market. But I mentioned it earlier in my remarks, there's not a huge amount of difference in production from this year to next on the medium duty side. Whereas on the retail sales side, you do see a bigger delta. So we're expecting a drawdown of inventory, which is keeping an artificial cap on production, probably to the tune of, I'd say, 15, maybe 20,000 units next year. So that's all I've got for now. Frank, if you want to take it away.
The next slide here. Steve, the slides are not moving for me.
Okay.
So if you could, there we go. That moved. I think I got a hold of that one. So let me address the trailer market here briefly. We've certainly seen things come back from the spring doldrums, at least through July. We almost were net negative in April. Backlogs were negative 17 out of there, slid 17 out of 18 months there. And as a result, OEMs were adjusting their production to try to get things in line with the order boards. But given that backlogs continued to slide, it was not enough adjustment to really halt that delta. So we did see a small turnaround in the order board in July, and August we'll push backlog to the best since we've seen in March, because if we go to the next slide, we were able to release the preliminaries today, and it's not moving for me again, Steve.
Give me just a second here.
Thank you. August preliminaries, we've had a very solid month order-wise, 27,500 units. So that growth trend that we started to see in May continues. Almost 29,000 new orders. So the difference there would be cancellations. These cancellations were low as well, which is also positive. Heavily dry van oriented, up 41% month over month. And if you remember, last year we were in an order doldrum for trailers, and dry vans are up 400% year over year. That's a really easy comp. I think that's one of those easy comps that type of comps that Kenny referred to earlier. On the reefer side, we saw things up almost a little more than double month over month, and about 2.5 times better year over year. Again, the indications are that the large fleets are driving demand. We talked about the e-commerce. We talked about the grocery. We've got situations where those fleets are coming into the market and are definitely making some making some noise. If we go to the next slide, we can talk about the haves and the have-nots. It's definitely a two-pronged market right now. The dry vans, the reefers, and the flatbeds are doing well. The vocational categories are having difficulties. The question is, do we have more strength to come now that we've seen things turning around order-wise for several months in a row here? Discussions seem to indicate that there are still negotiations going on. Some people are still trying to fill some spots in the fourth quarter, but if you take a look at these preliminary numbers, given the August build rates for dry vans and reefers, their backlog to build ratios stretch out 6 months. So if you think about the calendar, that's well into Q1 at current build rates. We would anticipate build rates will grow a little bit as we close out the year, but not significantly. You can't turn that. You can't turn things real quickly from a build rate standpoint. We hear that there could be some concerns with fleets over availability and timing of product, and also from the OEM side that they could be challenged now that the production volumes are off to restaff to meet some of this increased demand. The next slide will show a history of production. This is something I used in our seminar, and I've got it updated here in a second to show where August pops in here. This is the production by month, highs and lows for total, and we see what the average is across that time frame from 2011 to 2019. So if we go to the next slide, we'll see how things have plotted this year. We started out very average. Things fell off in March, dropped further in April, COVID-related, not surprising, and did increase a little in August, but we're still well below that range that we saw for that decade. August was up 7%. We're month over month, but off almost basically half of what we had a year ago. We do anticipate some improvement later in Q3 and Q4. If we go to the next slide, we will show what our current forecast is from obviously things are softer, but we are definitely seeing some attitude improvement in the fleets. Again, heavily. I think there's some heavy e-commerce impacts there, as well as the temperature control side. We are seeing backlogs improve. The good thing, cancels are minimal, so the units that are in the on the order board certainly seem to be solid right now. Obviously, we've upgraded this forecast a little bit since we had our last webinar, and remember that right now we have a situation where this is kind of the haves and the have-nots. So with that, I'm going to pass it back to Steve, and we can close out and move to Q&A.
Okay, sounds good, Frank. Did I tell everybody when I started my remarks that my forecast is that we were behind schedule and that Frank and I would make it up for you? If I forgot to tell you that, I apologize. Except for the Q&A piece, so I won't belabor the point. While you're taking a look at the summary of the forecast here, we do have a question or two, I think, in the queue, but you can go ahead and chat your questions to Act Research, and I will facilitate those. So while you're thinking about what you'd like to ask, the first question that we have, you guys are off the hook. It's for me. It's a used truck question, and actually a comment and question. One of our attendees writes in and says that in the wholesale segment of the used truck market, there is no inventory. And our attendee makes a really good point. When the market started slowing, really even before COVID, it was more about the capacity balance in the freight markets. Dealers were some of the first folks to stop transacting, buying or selling. And so, in essence, what we've got is this pipeline that's run dry. And we're just now, I think, getting to the point where the conditions are sufficient to prime the pump and get trucks flowing again. So part of that, of course, hinges on values, and that was actually one of the other comments and then the question that we had. Values are starting to improve in the wholesale market. We've seen them move from kind of low to mid 20s to $30,000 in the July and preliminary August data. And the question, of course, then is, where are they going to go? And as much as I'd love to be able to formally give you a forecast on that right now, that's something that we are still working diligently on. But I would venture to say that, there's probably, particularly within the wholesale channel, probably a good 10 percentage points of space to run. So we could see, kind of low to mid 30s as an average sale price by the time that we get out to the end of the year. I talked long enough. We did get another question, and I think this one is going to go probably, Kenny, to you. Question is, regarding the higher inventories, that limit the bounce in heavy-duty production, or does it lead to some kind of obsolescence of trucks that are in inventory? So I guess I can comment on that as well. And then also, is it possible that we've seen a structural change and the OEMs are just going to run with higher levels of inventory? What are your thoughts?
Yeah, those are good questions, but I do think there's a lot more dealer rooftops. So there is probably some increase in appetite for carrying more inventory, but I think you look at the bottom on the inventory in 2009, it was down around 25,000 units. And we haven't increased rooftops all that much to say, well, the bottom was 30,000 units in 2009, and the last couple of downturns we've been in the 40 to 45,000 unit range. So to see a bottom at 55 to 60,000 units implies a greater willingness. In 100% speculation, perhaps the OEMs got out in front of this and did a better job early on getting spiffs out in front of their dealers. Again, 100% speculation. But I think also what we've been talking about this entire hour is the recovery in the goods segment of the market. sharp, not unprecedented drop in driver supply, but just the ferocity of the drop in driver supply created, kind of an immediate flipping of the supply-demand balance, which we thought pre-COVID was going to take all this year. And, we have the worst economic downturn in the history of the United States. And, you snap your fingers and the supply-demand balance, went from one shoe to the other shoe. And then, so I think I've maybe answered, or at least I've shot around the target enough. But I think one of the things is as we look forward, I can't talk to inventory obsolescence. I assume most of it moves reasonably well. It's just carrying more inventory and some. This is worth a comment for the folks that are left on the call. Is our inventory number is an all-in inventory number. So it's not just stock trucks. It's what I would call the in-process trucks plus stock trucks. So in-process would be built but still at the factory, in transit at the dealer, but in prep for an earmarked customer. So the way I think about it is that any given time, 1 month of the inventory is probably in that in process. So anything above a 1 month inventory to sales ratio is going to be the stock part of the market, and clearly there's too much relative to sales now, but it's certainly coming around. And just one final comment here is one of the things when we come out of a downturn, and it's a slide that I've shown quite frequently over the years, which is when you come out of the downturn, inventory builds at about 2,000 units per month to industry production. With the inventory already at say 60,000 units at year's end, there's no need to add that extra 1,500 or 2,000 units a month. So it's hard to push the production assumption too much above where it is at that 255. So anyway, that was a long-winded answer, Steve. So back to you. You're on mute.
Yeah, I was trying to find the button. I'm too quick on the trigger. So let me make a last call for questions. And while I'm doing that, just remind you of some upcoming dates. Our next webinar is going to be November 12th. That's the next, if you will, formally scheduled presentation that we've got. We're going to try something, not the next one, but the next one that you know about. We're going to try something a little bit different. And as the title implies, we're going to fuel your day. Some conversations about what's happening in the alternative powertrain source. So Jim's going to talk about what's happening with electrification in the middle of October, so about a month from now. And then Drew Lang, who many of you may know is one of our industry advisors, will talk about natural gas at the beginning of November. So we'll send notices out about that. You'll be aware of how to connect with those sessions if you're interested. I'm not getting any more questions, so I guess I'll take this opportunity to say thank you, first of all, to all of our attendees. We appreciate your time and your attention today during the conference. And then one final thank you to Penske for being a sponsor for our webinar series. So thanks to Penske, and we look forward to chatting with you all in the not too distant future. Take care.
Cheers, everyone.
Thank you.
Bye-bye.